Hey everyone, I am Gary Litsky, president and founder of Break of Day Capital, and joining me is our very own director of asset management, Tim Chui. We're going to go over common questions investors have had, and we're really excited about this deal. Have a ton of interest. Wires are coming in, and things are moving along very nicely. What I love about this deal is it hits on the four major quadrants that every smart investor wants, which is appreciation, depreciation, cash flow, and capital preservation. And without further ado, let's jump into the questions. So they had a fire a few years ago, and so their insurance is a little bit higher. So what the question there that is in the chat is what specific mitigation steps are being taken to reduce future fire risk?
Thanks, Gary. Yeah, so there was a previous fire that happened in Q4 of 2023, and it was a kitchen fire, so it wasn't electrical related. So, we didn't, none of the electrical panels or the lines were at fault. While we can never totally remove the risk of fire, the seller did install range hood fire stops, which are preventative in all the units to enhance fire suppression starting in Q1 of last year, 2025. Moving forward, we'll continue to diligently do our annual fire inspections and full unit inspections to ensure that we eliminate, any fire risk and any unit fire alarms are fully operational, all the batteries are changed out, and all the fire extinguishers are up to date.
And in our underwriting, in our pro forma, we have a meaningful insurance drop in year four as that prior loss comes off. What happens if we don't get that to come off the insurance cost?
Yeah, so we will attach it in the written FAQ, but there is a sensitivity table, and based on the final underwriting, which we see that insurance will start to normalize after year four, because insurance companies that have a 5-year look back, so on the sixth year, usually that rolls that off. It's kind of like your credit score has a 7-year and then rolls off. Holding all the other assumptions constant, including a 6% exit cap and a 90% economic occupancy, we're going to get to an IRR of about 14.6% and an equity multiple of 1.78 with an estimated exit value of just under $49 million. So this is compared to our base case, which is 16% IRR at 1.9 times multiple and a $50 million exit value. So even in the worst case scenario, the returns are impacted not in a dramatic fashion, which is what we wanted it to be. And that also kind of shows how conservative our original base case underwriting is, because we did account for, a lot of other potential downsides. In that case, the impact is primarily slower net operating income growth rather than impaired on the exit, given how low the basis and conservative revenue assumptions were.
And the insurance cost on this property, comparatively across our whole portfolio, 1,400 units, this is probably more than twice as expensive for that. So this is definitely an outlier, and that's why we're very confident in it coming down, but protected if it doesn't.
Yeah, yeah.
So let's talk about really the biggest CapEx um, line item we have, which is replacing the two boilers and the lines. So talk to me about that. What's the scope of work and the bid and all everything that entails that.
Yeah, so we have engaged with multiple consultants, including the existing contractor that services the water lines and the boilers at the property. So we have, existing scope of work, and the budget is in line with, the bids. And of course, we're continuing to negotiate with them and, reach out to other contractors and vendors to try to lower that price. But this is kind of all inclusive, the highest it will only be lower. So yeah, we do have, bids and we continue to discuss. So the issue is there's kind of two major issues. There's the water storage tank and then there's the boiler, which both need to be replaced. And then there's also the line issue that needs to be relined. So we're going to do it in phases where we have the least interruption as possible. But we have heard that some of the units farther away from the boiler and the water heaters that, it sometimes could take them up to 10 minutes to get warm water. So when we wrote this deal, we knew that the seller wasn't going to, invest a capital expense to upgrade it. And that was a major reason why there was a $3 million reduction from when the deal first came on the market. So, that accounts for the initial CapEx that we had to put forth from the discount of the sale price. So, we've spoken with the plumbing company. We have a game plan in place. It's going to be the first 6 to 9 months. That's going to be the priority. And then we believe that from that, we're gonna be able to have better retention, increased rents because when people aren't getting hot water and when they have complaints, people leave and we can't increase rents as much as we want to. So we feel like just from replacing that, one, it's capital preservation, right, which is a huge deal for our investors, and then also longevity of the property that it will be priced in when we sell the property as well because we can show the next buyer, hey, we just updated 3 years ago, 5 years ago, it's still pretty much brand new, and they're going to be able to value that in their savings as well. So yeah, we extensively talked to multiple consultants, talked to the residents to get a lot of feedback.
Yeah, I'd add, just a very proactive approach versus, maybe some buyers would try to squeeze through maybe their term, and that doesn't bode well for resident retention, and also like you said for the next buyer too. So it's we've done it before on another property. Coincidentally, that was our highest return for investors on that property. So hoping for a new high on this one. All right. So, let's see. What is the current occupancy and talk about economic occupancy, delinquency at the property?
Yeah, so the most recent occupancy report that we received, the property is at about 91%. And then there's the economic occupancy, which includes delinquency, vacancy, concessions, and any other adjustments. So our economic occupancy is at around 85%. If we average out and look at the T30, the past month. Delinquency trends, we're seeing pretty market bad debt and delinquency. We have a property less than a mile down the street, and it's pretty comparable. And then concessions is also pretty market, 1 month free. Yeah.
And those are trending, improving as we continue to move forward through 2026, where those numbers should come down as far as the delinquency, concessions, and whatnot, and economic occupancy should be trending up.
Yeah. Yeah.
So, who is the current property manager, and do we intend to keep them?
Yeah. So the current property management company is called RPM Living. I believe they're the second or third largest property management company in the country. They manage, I think, over 200,000 units across the country. So they're a national manager with institutional knowledge and quality and history. So they're the current manager, and we do intend on retaining them. They've done a great job at a 300 unit property, and we do believe that they have a strong system and support in place. And we met the manager, the regional manager, the regional vice president, and then pretty much everybody beyond that we've met, and we feel they put in a really good game plan together for us. and we're very confident they're going to be able to execute.
And you've had experience working with them in the past, correct?
Yeah, yeah. I've had multiple properties, I've had portfolio properties across multiple markets with RPM. So I'm really familiar with their senior leadership.
Nice. So this is an older 1980s asset. What happens if CapEx exceeds budget? What is the plan? Um, and talk about similar properties that we have.
Yeah, so we have a lot of experience in properties that are 80s or older. We currently, out of our portfolio of 8 properties, 5 are, which is around 1,000 units, were in the 80s or earlier. So we're very familiar with potential CapEx, roof, HVAC, paint, hard turns. So we've been conservative with how we budget it in the performa. We allocate nearly $300,000 between miscellaneous line items, contingency, and of course, we have working capital as well, that we get right away. So we have, ample amount of room, for unanticipated, you know, events.
We talk about basis a lot on this deal, and we mentioned some of the deferred maintenance, but anything else to to get this price that we're getting at just a hair under 110 a door?
Yeah, so there are other CapEx items that we've budgeted for, and Gary and I, we both walked the property multiple times, with vendors, with consultants, with inspection people. So landscaping, we have a budget for. Paint is a big deal. We typically paint, all the deals we purchase. There's signage, there's plumbing reserve, which is not for the boiler. This is a separate line item. This is for, if there's a mainline break, if there's a leak, whatever it is, we have a budget for that. We have a really healthy budget for roof, and we always should because that's always a really large expense if anything happens. And we have bids on that as well. So we believe our pricing is very accurate. HVAC, we always budget for that. And Tucson, hot weather, AC is always breaking down. So we have a budget for that. Boiler lines, boilers, cold water lines, you already discussed. Parking lot resurfacing, pool deck, water cartridges. We also have, a package locker that we anticipate we're going to install. And that's going to be another, revenue generating, capital expense that we're going to put forth.
Let's talk about the pro forma for a minute. What are some of the ways that we can increase NOI through income lines and decrease expenses?
Yeah, so I can go down the list starting from revenue. So some of the things that the current owner isn't implementing, one is valet trash. We want to implement that. We also want to renegotiate their bulk internet deal. That's another potential that we can increase our door fee, our revenue sharing. And then the big item is the smart keys and the smart, locks that they've installed in all 300 units, smart thermostat. So we're charging a premium for that as well. So that's going to continue. And then we're going to make sure we're enforcing parking, pet fees, late fees, just staying on top of the operational other incomes, renewals, making sure that, people are renewing at a high rate. Our retention is really high. Every time, people leave, there's turnover expense, there's vacancy loss. Sometimes there's concessions that we have to be aware of. So it costs us a lot more money to, get a new lease compared to just keeping people in place. So I want to make sure we emphasize that. On the expense side, we potentially could see savings on payroll and staffing because we have implemented at least AI at a lot of our other portfolio properties. So that's something that we're looking into as well, that we anticipate we'll be able to get. And then, a lot of their other expenses that, marketing, general and admin, we're able to save money on. And then with the water lines, when people are running water for 10 minutes to get hot water, if we install a new boiler and new storage tanks, we're going to be able to save our water expenses tremendously. And we've seen a lot of great financial results from installing, low flow toilets, low flow shower heads. That's something that we're going to explore as well.
Let's
And
talk about
obviously, the insurance is a big piece as well, after
right.
year four.
Let's talk about the unit interiors. Or, um, what shape are they in? How many are renovated? Talk about that.
Yeah, so out of the 300 units, about 85% of the units have been renovated, and it's, up to the standard that we will usually renovate to. There's new paint, new countertops, some of them have new cabinets, and then the ones that are fully renovated, they have backsplashes, upgraded stainless steel appliances. So we feel like the floor is really high with this deal because the property is renovated, and we feel like there's additional opportunity for the additional 15% that we could renovate. So there's always opportunity to increase revenue on that side as well. And from all the units that Gary and I walked, and also, you know, the full, 100% unit walkthrough that our property management company conducted, the reports came back, pretty good. There's always going to be a few bad units, but overall, everything seemed like people take care of the units, they care, they have pride where they rent. So we always like properties like that.
Let's talk about downside risk. I mean, that's something we always, spend a lot of time looking at. If we're obviously we have rent growth 0 the first year, but what other, if we don't have rent growth for multiple years, what does that look like? Or the exit cap ends up being higher. What are the things? How does that affect the deal? And what are the when you're underwriting, what are you looking for and tweaking?
Yeah, so I think with our rent assumption, it is pretty much the downside. Obviously, you can go zero everything out, but we believe that one big thing that we track is supply. And Tucson had the largest historical delivery in terms of supplies in 2024. In 2025, a lot of that was being absorbed throughout the whole market. So that's kind of why now is the best time to buy because we're at the tail end of where valuations are really low and cap rates are really high. And, we believe that it can only go down from there in terms of the cap rate and the valuation will increase. So that's kind of the cap rate component. But even with that being said, we pretty much account for very minimal or zero cap rate compression. Whatever we bought it at is pretty much what we assume we're going to sell at in terms of cap rate. So, we think it's going to go lower. We're confident it's going to go lower, but I think a lot of our underwriting is it's not the absolute down, like lowest downside risk, but I would say we account for probably 50 to 70% of a lot of it and just being very conservative. Gary and I, we looked at, probably over 70 deals in the past, 2, 3 quarters. And then we underwrote, half of them. And we probably put in bids on like two or three of them. So we've been really, really selective and stress testing the deals and underwriting it in a way that, you know, with really high floors that, if something doesn't happen, how can we carry the deal forward operationally in ways that like we can control, right? Like we can't control the market rent, we can't control the cap rate, but other things that we can control, we put more weight and things like that to try to figure out the deal with pencil. And this is one of the very few deals that, was able to go through all those filters that we feel very confident in pursuing.
Let's talk about a huge advantage that we haven't talked about yet is our portfolio in Tucson. So we're going to go from 1,300 units to 1,600 units. So what kind of operational levers are we able to pull so that we could take advantage of that?
Yeah, yeah. So I think that's a huge part of why we feel so confident in this deal because we've had data sets, throughout the market for the past, 3, 4 years that we've operated in it. And we have a property a mile down the street in the same submarket. Like this property is a comp for our other property. So we're extremely familiar with the market and the submarket. We're familiar with the people, right? The vendors, the managers, who the good property management companies are, who are the top two, three vendors for each trade. So we feel really good about that. We know the pricing. I think everything is just a lot of synergy when you've operated in the market for so long. And we go out there once a month. So even prior to us getting this deal or looking into this deal, I've been to River Oaks multiple times, just shopping it as a comp for our existing property. Um, so I think those are some of the things, staffing, we're able to, backfill and, move staff around to create, synergy that way. So we feel really good about where this property is and kind of the resources we have in the marketplace.
Yep, absolutely. I guess one last question. So, if the exit market is soft, let's say in 3 or 4 years, what happens? What do we do? Because I know we tell investors it's 3 to 5 years. Obviously, it gives us some margin for error, but if the market is soft, what can we do?
Yeah, so we do have, contingency plans and different scenarios when that happens. So one of the primary would be to extend or refi. So we'll talk to different lenders and figure out different structures. We have a lot of good relationships with lenders and prep partners that's been willing to work with us. So and obviously we'll keep tracking the market and we'll figure out like if 3 years in, if it's a good opportunity to refinance, maybe we lock in, a longer term loan that give us a little more runway. And we do believe, the rates would come down in the next 3 to 5 years. That we're pretty confident that will happen. So we do have some runway and optionality. Gary and we're always looking at prepayment, penalties and optionality and best ways to structure deals, and working with our lenders and prep partners on that. So we'll continue to do that. It's not like, oh, we hit year five, what are we going to do? It's every year, every month, we're evaluating what's the best opportunity, for every deal we have.
Tim, thank you so much for providing answers to a lot of our investor questions. You're a huge asset to Break of Day Capital, and looking forward to closing this deal.
Yeah, thank you.
All right, everyone. If you have more questions, please don't hesitate to reach out, whether it's me or Andy or Joe. We're happy to answer your questions. Thank you for taking the time, and we'll talk to you soon.